Have you seen mortgage companies implode, close shop? Mortgage rates. It's the topic that everyone wants to talk about. I don't predict mortgage rates, but I know that you'll talk that talk a little. And previously, many expected Jerome Powell and the Fed to drop their rate 4 times this year, then two, and now more and more expect zero rate cuts at all this year, even opening the door for rate increases if inflation persists. So tell us about the propensities of this year's mortgage rate direction.
I think that I agree with a lot of the volume out there related to interest rates kind of stay in the course. I don't think we're going to see too much of a decline. There's certainly, Keith, we talk about this ad nauseum. There's all kinds of things that could derail that statement that we can't prepare for, we couldn't predict for. But I think overall rates are going to stay steady. I think that whether you like them or you don't like them, the tariffs tend to come with an inflationary tone. And if that's the case, it's going to put Jerome and his buddies at the Fed in a tough position to do what they had hoped to do with the easing, the monetary easing. So I don't expect to see it, but I'm hopeful. Well, who knows?
Real estate industries are shrinking, and it's all related to the fact that back in 2021, the number of existing homes sold peaked at almost 7 million, but last year it was only about 4 million. That is a huge drawdown. The number of US realtors is dropping since it peaked in 2023. And Chaley, from what I can see, the number of loan officers even operating has dropped precipitously over the last 4 years. And it's a reminder that the strong survive. And in the mortgage industry, top service is what savvy borrowers need. You go with the people that consistently advise you to take your time and look at your long-term strategy and make the correct decision, not always the one giving like 1/8% lower in an interest rate. So any lender can get you the next loan, and few are going to help you with your long-term strategy. So with this overall lower volume of transactions taking place, what are your thoughts about how it's impacted the mortgage and lending industries?
Well, it's such a good question. I'm glad that you asked it. And I really do think it speaks to the experts in the space.
Yeah.
And consumers, our borrowers, as we call them, have to be, I believe, a little bit more discerning about who they want to align themselves with and who they want to work with. As it relates to the interest rate, we're competitive, but we're never going to be the lowest possible lender out there. There's always going to be somebody that can undercut for an eighth, like you said, a quarter point, a few $100 here and there. And we just don't get into that. Our value adds far exceed an eighth of a point in rate, which, by the way, you probably can predict what I'm going to say next. If you're not doing the math, just as a sidebar, listener, the difference in payment, and that's really where the focus should be, the difference in payment on an eighth or a quarter% in interest rate on $100,000 is all of $5, $7, $8 a month.
Yeah.
Okay, so make sure you're doing the math. But the value adds that come with the education that we provide, the 49 states, large footprint, and the diversity of loan product, I think far outweigh any eighth or few $100 difference when you're comparing side by side. I'm not saying that you don't want to get comparisons and you don't want to be a smart, informed consumer, but it really does matter that your lender understands known owner occupied, understands how to take you from point A to point Z today and 5 and 10 years down the road.
You've been a mortgage industry leader for a long time. With this lower volume, have you seen mortgage companies implode, close shop?
Absolutely, we have. We have access to those data points, and the number of loan officers, just the individual in the doing the transaction, not including processors and underwriters and funders and doctorars, but just the loan officers, I believe in 2024 reduced by a margin of 53%.
Gosh.
Yeah, it's a big number.
Interesting industry trends in this environment where we have persistently higher rates. I make sure not to say high because historically mortgage rates are still not high, the long-term average being 7.75% on the 30-year fixed rate mortgage. Are there any other trends that this loss in activity has created?
You know, I feel like the informed investor is still finding ways to profit in real estate. They're finding diversity is key, which I'm a big proponent of, as are you. That means single family residence to 2 to 4 units. cash flow versus appreciation, the short-term rental, the long-term rental, the mid-term rental, making sure that they have a good rounded portfolio is key. There are some mortgage tools that I really feel like for an informed investor are allowing them to continue and propel further, even scale into the 25 and 26 years.
What's happened to the volume of owner occupied transactions versus investor transactions? I would imagine that investor mortgage transactions really aren't down that much.
Not that much. I mean, I'd say there was a small blip, but I feel like we've made those up with some of the BRRRR strategy loans. We do, of course, all kinds of mortgage related transactions specifically for investors. And one of those products is a short-term bridge loan, which would apply to the BRRRR method: buy, rehab, rent, and refinance. So we've been seeing quite a bit of that, where the investor will find a good deal on market or off market, where they can put a little bit of lipstick on it and then refinance it at the ARV, or after repair value. So anything that we might have lost in just the traditional 30-year fixed straight purchase transactions, I feel like we made up in the other, but it wasn't a big margin.
You can watch this one next.